Okay, let's take a look at some more exercises, and specifically the exercise we're going to look at next is titled Analyzing Transactions Using Financial Statement Effects Template. So what we're essentially going to be doing here is we're going to be looking at a series of transactions, and then we're going to be this template that we have here is in some ways similar to T accounts. We're going to have multiple accounts that are impacted, at least two, every time we come through here and consider one of these transactions. Now, these are not T accounts. Okay, but what we're ultimately doing is we're going to be placing figures in these boxes, and then at the end we're going to total up the account. So it looks like we're going to be dealing with cash and maybe some other assets, some common stock, or what they're calling contributed capital. Looks like we've got some revenues and some expenses, and then also we're going to calculate net income. Okay, all right. So with that said, let's see what we have here. So our first transaction up here, it says, is we're going to receive 50,000 euros in exchange for common stock. For whatever reason, the spacing on some of these is a little bit off. So in exchange is 2 words, common stock 2 words, and so forth. Looks like there's several of those as we get through here. Okay, so the fact that this is euros rather than dollars doesn't really impact anything. Okay, that's just a type of currency, and it is interesting that they're dealing with euros up here, and then at the bottom they're using dollar signs. But we will ignore that. So there's our scenario. We're going to record each of these independent transactions, and we'll use negative signs when appropriate. Okay. Not a real difficult exercise, but we'll look at it nonetheless. So it says the first one was to receive the 50,000 euros in exchange for common stock. So what we can do is we're going to deal with this cash asset here, and we're going to just plot that 50,000 right here. Okay, and then common stock is contributed capital. So we can plot that here as well. We do not have to deal with any non-cash assets. We do not have any liabilities. We do not yet have any earned capital from operations. We do not have any revenue. We do not have any expenses. And since we have neither revenue nor expenses, we do not have any net income. Now, do be advised, let's see here. Depending on the settings, if you were doing an assignment like this, like in an online homework setting, make sure that you read the instructions, because sometimes, depending on the publisher and so on, they want you to put a 0 in all of these boxes if we're not using them. Now, I'm not going to do that, and I didn't see anything in the instructions, but just always do pay very, very close attention to the instructions. Okay? All right, so in number 2, it says we're going to borrow 10,000 euros from the bank. Okay, so same thing, except that instead of having an owner contribute money to the company, here we're getting an additional $10,000 by borrowing. Okay, so we're going to put $10,000 in the cash account. However, And we don't have any non-cash assets, but we do have a liability here. Okay, and let me see if I can doctor this 0 up here a little bit more to make that look like 10,000. Okay, I think we've got it now. And so the next transaction here, number 3. Also, while we're on this topic, I can't remember what our instructions said, but you might they might want you to use a negative sign for liability. So again, just keep that in mind. Okay, number 3 says purchased $2,000 of supplies inventory on credit. Okay, so that's very, very important. And sometimes you will see this worded as on account. Now, the fact that they use on credit makes this a little bit easier, but sometimes I just want you to know this is called on account. They mean the same thing. That means that we're getting $2,000 worth of supply, so that's not cash, but it is a non-cash asset. So let's go ahead and plot that right here. Okay, and because it's on credit, we are also going to increase our liabilities by the same $2,000. And then everything else that we have here is not impacted. Okay. Number 4 says we're going to receive $15,000 cash from customers for services provided. So this is important. Now, obviously, we need to know, and there's certain accounts that are just not up here, but do understand that whenever we see services provided, this is one of those situations where we provided services and we received cash. So there would actually be no difference in how we would record this under either the accrual basis of accounting or the cash basis. The treatment would be the exact same. Okay, but the more of these little details that you can learn, the better off you're going to be. So we got 15,000, so we're going to plot $15,000. Okay. And so let's see here now. No non-cash assets, no liabilities, no contributed capital. However, this is earned capital because we provided services. Okay, so we are going to need to enter that 15,000 right here under earned capital. We will also need to enter that same 15,000 right here under revenue. And because these are services and we don't have any expense information associated with the generating of this revenue, we have a $15,000 positive impact to net income. Okay, so a lot going on in this particular transaction. Okay, so the way this is set up, we are entering the revenue after we're earning earned capital. So we've got balance sheet by way of retained earnings, and then we're in income statement, and then we're at income statement, right? And that's exactly how this is labeled up here. Okay, we're dealing with balance sheet and we're dealing with income statement. So you might be advised to kind of remember or draw a little line here. Everything from revenue over deals with the income statement, and everything to the left of that is balance sheet. All right, number 5, okay, says pay $2,000 cash to suppliers in transaction 3. So this is where we want to use our negative signs for sure. Okay, I couldn't remember what the instructions told us. So now, whatever you want, I'm going to use parentheses or brackets because our cash account is going down by $2,000. Okay. However, our liabilities are also going down by $2,000. So this transaction would, just like the previous transaction, there was no impact on equity here because we went up with an asset and then we increased liabilities by the same amount. So there's no impact on owner's equity here. This transaction, we have an asset cash going down by $2,000, but then we have a liability going down by the same $2,000. So again, no impact on owner's equity. Question or number 6 says receive order for future services with $3,500 advance payment. Okay, so this is a transaction where we are essentially dealing with what we call unearned revenue, which is also sometimes called deferred revenue. Okay, so we received an order for future services, meaning we have not yet provided these services, with a $3,500 advance payment. Now, I'm not sure if that's a down payment or if they just paid for $3,500 of services in advance. It actually does not matter because we haven't earned it anyway, but we do need to plot this $3,500 here under cash, and we're also going to have a $3,500 liability. Make sure you understand that this number 6 here is what we call unearned revenue or deferred revenue. Actually, I shouldn't use DR because that stands for debit. So I'm just going to call this unearned revenue. Okay, if I try to get any more in there, I won't be able to fit it. Okay, number 7 says pay $5,000 cash dividends to shareholders. Well, let's see what we have here. We've got, we're paying 5,000 euros, actually, I think I said dollars. So we're going to put that right here. And we're going to put negative sign, no non-cash assets, no liabilities, no contributed capital. However, we do have a $5,000 reduction to earned capital. Okay, so let's put that in brackets, and then the other 3, revenue, expenses, and net income, would not apply. Paying dividends has nothing to do with income. Number 8, it says pay employees 6,000 euros cash for compensation earned. So usually when we see something like this, you know, we would set up a liability, because as anybody who's ever had a job knows, you don't get paid as you earn that compensation. You get paid at a later date. But here, because this is kind of, we're just getting started with all of this, we're just going to have a couple of items here. Well, actually, we're going to have more than a couple. We're going to have about 3, I think. So let's see here. Pays employees 6,000 euros for compensation earned. So this is a reduction to the cash account. We never set up a liability for that payment, so we don't really have to do anything here. Okay, at least not the way that I'm reading this. Okay, so no contributed capital. Earned capital would be a negative 6,000. Okay, because this is wage expense, so this is a part of operations, and so we would record this as a negative $6,000 to earned capital. I don't have any revenue here. We do have $6,000. So notice, and then our net income will be a negative 6,000. So the cash asset went down by 6,000. So we're going to put that in parentheses. Let's see here now. Earned capital also went down by 6,000. Expenses went up by 6,000. So I didn't put a bracket around that. And then we have net income with the bracket around the 6,000 because it was impacted by that amount. And then finally, number 9, it says paid 500 euros cash for interest on loan in transaction 2. Okay, so we did not set up any kind of, we have a liability, but it just says that we've paid cash for interest on this transaction up here where we borrowed the $10,000 from the bank. So what we're going to do is we're going to say, okay, I paid $500, so the cash asset definitely goes down. we're not going to touch liabilities. Not going to touch liabilities because there's no evidence that we have paid any of the principal amount on that note. Let's see here. No contributed capital. We are going to need to, because interest expense is going to be on the income statement, and if it's on the income statement, that means it's going to reduce earned capital or retained earnings. Okay, so nothing on revenue. Expenses go up by $500, and net income goes down by $500. And so then I'm not going to do all of these, but I'll bring the calculator over here for just a moment, and we'll go down. Cash is the biggest one, so we'll do that. The cash account, we started off with the $50,000 owner investment plus the $10,000 financing activity when we borrowed money from the bank, plus $15,000 in earned revenue. Okay, that gives us $75,000. Now I'm going to subtract out the $2,000 that we paid for the supplies. Okay, then we took in $3,500 and recorded the liability, but right now we're just worried about the $3,500. Okay, and then we're going to pay the cash dividend. Okay, and then we're going to pay employees $6,000 cash. We're writing them checks or making direct deposits, but it's impacting the cash account. And then finally we're going to pay $500. Let's see, I already hit that, so we'll do it again. And so our ending cash balance is going to be, let's see here, $65,000. Okay, $65,000. Our non-cash assets are we just had the one here, 2,000, and then let's see here now, liabilities are 10 plus 2 is 12, minus 10 plus 35 is 13,500. And then let's see here, what else do we have? Contributed capital, we just had the one transaction of 50,000. And then the earned capital, let's see here, 15,000 right here, minus 5 and 6, minus 5,000, minus 6,000, minus 500 equals 3,500. And then let's see, revenue, we had just one transaction for 15,000. Expenses, we had two, 6,000 and 500, so that's 6,500. And then net income, we had the $15,000 in revenue minus this 6,500. Okay, giving us 8,500 for net income. Now, we can kind of do some things to kind of check our math as we go. Move this out of the way just for a moment. I want you to notice that in the earned capital column here, we have 3,500, and in the net income column, we have 8,500. And this is correct because of what took place right here in transaction number 7. So net income and dividends are two separate things. We had $8,500 in net income, okay, and that $8,500 flowed into the statement of retained earnings, and then we subtracted out 5,000 of that because we're paying it to owners or shareholders, and then the remaining 3,500 is what's left, or is what is said to be retained by the business, and so then that would flow over to retained earnings on the balance sheet. Okay, so if we wanted to quickly kind of apply the accounting equation here, we could do that. We have $65,000 in cash, and we have $2,000 in non-cash assets. Make sure that looks like an L and not a 2. So we have $67,000. For liabilities, we have $13,500. So we can just, write that down. And then, so for, let's see here now. For our, where am I at? I've lost my spot. Oh, there, okay, there we go. For equity, we have to add 2 numbers. Now, I just noticed I made a mistake here. This is supposed to be 50,000, so I was missing a 0. All right. So I have to add my contributed capital to my earned capital. Okay. And if I do that, I'm going to be taking 50,000 plus this 3,500 because there are 2 components to equity, and that's going to give me 53,500. And since I have 53,500 on the calculator from these 2 columns right here, I'm going to add liabilities to that to prove that, in fact, assets of 67,000 equal liabilities plus equity of 67,000. And that is all there is to it.